What happens if the person who signs the checks in your business is gone tomorrow? Not emotionally, practically. Payroll still runs, vendors still expect payment, and clients still call, but authority stalls, decisions slow, and cash flow tightens in ways most owners have never had to model. Before we go any further, a quick clarification. This is general information meant to explain how these tools work in practice. We are licensed life insurance agents, but we're not here to give legal or financial advice. The details always depend on your business structure, tax situation, and agreements, so those conversations belong with your own advisors. Most business owners don't think about life insurance while they're reviewing payroll, approving invoices, or dealing with routine operational problems. You're focused on execution, getting through the week, keeping the business stable. Insurance usually only comes up when it's tied to something physical like a building, a vehicle, or a workers' comp claim. That mindset makes sense for day-to-day operations. It starts to break down once the business reaches a point where one or two people matter in a very practical way. Someone controls money, someone controls relationships, someone makes decisions that can't be easily delegated. Most of the time, that dependency doesn't show itself. You show up, your partner shows up, employees do what they normally do, clients keep paying. Years can pass where the idea of losing an owner or key executive feels abstract rather than operational. When it does happen, though, the impact shows up fast and in very ordinary places. Payroll timing, loan payments, vendor confidence, client retention. The business does not collapse, it stumbles. Revenue dips, decisions take longer, hiring costs appear where they never existed before. That's the environment where key person life insurance actually matters. It functions as a cash flow tool during disruption, providing liquidity that helps the business absorb short-term strain without forcing rushed decisions. In most businesses, there is at least one person whose sudden absence would create measurable strain. A founder who's handled pricing and sales strategy for years, with judgment built from trial and error that doesn't transfer overnight. And an operations lead who knows the quirks of your systems well enough to prevent problems before they surface. Or a partner whose long-standing relationships with lenders and major clients quietly keep doors open. Think about a tech startup where the lead developer holds the institutional knowledge behind custom systems, or a restaurant where the head chef's experience and supplier relationships define the menu and margins. Losing that expertise overnight changes how the entire business functions. If that person is suddenly gone due to death, and in some cases, long-term disability, the business still exists, but it may need time to adjust. That adjustment period is where costs quietly accumulate. Outside consultants get pulled in. Staff shifts stretch people thin. Small inefficiencies start turning into real expense. Response times slow, workloads increase, and the margin for error narrows. Key person life insurance exists to give the business room to breathe during that period. The business owns the policy, the business pays the premium. If the insured person dies, the business receives the proceeds. The money isn't there to replace the person, it's there to buy time. That time might be used to recruit a replacement without rushing into a bad hire. It might keep payroll steady while revenue softens for a quarter or two. It might prevent the need to take on expensive short-term debt just to keep operations normal. The proceeds generally are not restricted unless tied to a loan requirement. They exist to stabilize decision-making so the business can respond deliberately instead of reactively. In practical terms, that might mean funding training for an internal promotion, covering temporary staffing costs, or maintaining service levels while operations recalibrate. Where this often gets misunderstood is how the amount is set. It's about asking what realistically changes in the business over the next 6 to 18 months if that role disappears. In a service-based firm, it might mean covering lost billings, while training ramps up. In manufacturing, it could mean bridging operational or supply chain friction. For a retail operation, it might involve offsetting inventory or purchasing disruptions without the oversight of a key buyer. The point is aligning coverage with how the business actually functions based on real financial exposures and operational dependencies. This is different from personal life insurance. Business-owned policies exist to protect the entity. Personal policies exist to protect households. Mixing those purposes is one of the most common planning mistakes business owners make, often leaving families exposed or businesses underfunded. Many owners assume personal coverage will naturally solve business obligations, only to discover later that those dollars need to serve very different roles. Now, shift to buy-sell agreements, because this solves a different problem entirely. This isn't about operations, it's about ownership continuity. In a multi-owner business, the absence of a buy-sell agreement usually doesn't cause immediate issues. The business keeps running. Employees may not even notice. The problem surfaces when ownership rights meet legal reality. If an owner dies or becomes permanently disabled, their ownership interest does not disappear. It becomes part of their estate or legal rights. That means a spouse, children, or other heirs may now own part of the business, whether they want to or not. From the surviving owner's perspective, this creates uncertainty, voting authority, distributions, access to financials. From the family's perspective, they may rely on that ownership interest financially while having no desire to participate in the day-to-day operations. A buy-sell agreement sets expectations before anyone is under pressure. It establishes who can buy the departing owner's interest, how the value is determined, and how the transaction happens. Without funding, though, the agreement often stays theoretical. Valuation methods might include fixed formulas, earnings multiples, or independent appraisals, but whatever method is used needs to reflect how the business actually operates and evolves. Life insurance is commonly used to fund that buyout. The goal is simple. The family receives value without becoming accidental business partners. The remaining owners retain control without draining working capital or taking on debt. I've seen stable companies turn into years of litigation and operational drag simply because no one decided these things ahead of time. A family-run business loses an owner, and suddenly, surviving partners are negotiating with in-laws over shares while customers wait and legal costs climb. In professional firms, ownership disputes can stall growth, delay decisions, and distract leadership. Not because anyone acted badly, but because nothing was clear when it mattered most. These arrangements are not about predicting tragedy. They exist for rare disruptions that carry disproportionate impact, especially in closely held businesses where ownership and operations are tightly linked. This applies even if you're a solo owner. If authority, cash control, or key relationships all run through you, your sudden absence can still freeze decision-making and strain the business in ways that affect employees, clients, and family members. In those situations, coverage is sometimes used to support a structured wind-down or ownership transition that protects enterprise value. One practical issue that often gets overlooked is valuation. Buy-sell agreements need to reflect the business as it exists today, not what it was worth years ago. Outdated valuation methods tend to surface problems at exactly the wrong time, undervaluing growth or triggering disputes. Periodic review keeps expectations aligned with reality, particularly after expansions, acquisitions, or significant operational changes. From an operational standpoint, clarity is the real goal. Who owns what? Who gets paid? Who decides how money moves? These are the questions that surface when an owner or key person is suddenly gone. And these tools exist to keep those questions from becoming emergencies. A useful way to pressure test your own setup is to pause and think through your dependencies. Who controls cash? Who controls relationships? Who holds authority that isn't easily transferable? Ask whether those roles are distributed or concentrated. Ask whether ownership transitions are clearly defined or simply assumed. If you can answer those questions readily, you're already most of the way there. If not, mapping those dependencies on paper often reveals operational risk that isn't obvious day to day. Most businesses will never trigger these arrangements. That's normal. The value is knowing that if something does happen, decisions are not being made for the first time under stress. As a reminder, this is general education only, not advice tailored to your situation. Conversations about life insurance, tax structure, and legal agreements should always be specific to your business and guided by your professional advisors. I make videos that put insurance in plain language for everybody to understand. So if this was helpful, click like or subscribe so you see future videos as they come out. Thanks for watching.